Friends, thank you for being here today. It is with a sense of urgency, tempered by the necessity for calm analysis, that we must address the events unfolding in the global financial markets as of Tuesday, January 13th, 2026. While the daily fluctuations of ticker symbols often distract the average observer, there are rare moments in history when a structural change occurs, a shifting of the goalposts, so to speak, that signals a much deeper tremor in the bedrock of the global economy. Yesterday, Monday, January the 12th, we witnessed one such structural shift. As silver prices broke through the significant resistance level of $85 per ounce, and as the Shanghai Futures Exchange traded at a commanding premium of $93, the response from the establishment was swift and decisive. The Chicago Mercantile Exchange, CME, the governing body of the COMEX futures market, issued a margin notice advisory. To the uninitiated, a margin notice appears to be mundane bureaucratic housekeeping. To those of us who have studied market history, specifically the events of 1980 and 2011, it is a siren. It is a signal that the paper market is at war with the physical market. They have changed the rules of the game effectively immediately, altering the margin requirements for silver futures in a manner that seems surgically designed to impact retail investors and halt the momentum of the current rally. I am curious, how many of you recall the market atmosphere during the Hunt Brothers era of 1980 or the margin hikes of 2011? If you were active in the markets back then, I invite you to share your memories in the comments below. Does this current move by the CME feel like a repetition of history to you? In our conversation today, we are going to look past the headlines. We will strip away the emotion and look strictly at the arithmetic, the historical precedents, and the macroeconomic data that suggests this rug pull is not the end of the silver bull market, but rather a desperate confirmation of its validity. We will analyze the 38% signal, the impending liquidity crunch, and why a price target of $375 per ounce is grounded not in fantasy, but in the cold realities of supply, demand, and monetary debasement. To understand the gravity of what transpired last night, we must first dissect the mechanics of the futures market. The futures market was originally designed as a hedging mechanism for producers, miners, and consumers, manufacturers, to lock in prices and stabilize their business models. Over decades, however, it has evolved into a highly leveraged arena of speculation, dominated by large institutional banks and, increasingly, retail traders seeking to protect their purchasing power. The engine of this market is margin. When an investor purchases a silver futures contract on the COMEX, they are not required to put up the full cash value of the 5,000 ounces of silver that contract represents. Instead, they post a performance bond, or margin, a good faith deposit that ensures they can cover daily losses. For some time, this margin was a fixed dollar amount. Until yesterday, to control a contract worth hundreds of thousands of dollars, a trader needed to post approximately $3,500 in capital. This system provided certainty. It allowed traders to calculate their risk and allocate their capital efficiently. This leads us to the specific notice sent out by the CME, which has fundamentally altered this calculus. Effective immediately, the exchange has moved from a fixed dollar margin to a dynamic margin calculated as a percentage of the notional value of the contract. Specifically, the new requirement is set at 9%. Let us apply the arithmetic to see the immediate impact on the retail investor. With silver trading at $85 per ounce. Now, you might ask, why does this matter? One might argue that an 18% increase is a reasonable adjustment for volatility. However, this view fails to account for the concept of leverage, which is the double-edged sword of the futures market. Many retail investors, seeking to maximize their exposure to the silver rally, operate with limited excess liquidity. They are fully invested. When the margin requirement is raised overnight, these accounts instantly fall into a deficit. This triggers the dreaded margin call. This morning, thousands of investors woke up to a notification from their brokers. Deposit more cash immediately to meet the new $38,250 requirement, or your position will be liquidated. For the institutional banks, the shorts, who have bet against the price of silver, access to capital is rarely an issue. They can tap into vast liquidity pools to meet increased requirements. The average retiree, the small business owner, the independent investor managing their own portfolio, these individuals often do not have an extra $50,000 or $100,000 sitting in cash, ready to be deployed at 8 a.m. on a Tuesday. Consequently, they are forced to choose the second option, liquidation. They must sell their contracts at the prevailing market price to close their positions. When thousands of traders are forced to sell simultaneously, strictly due to a regulatory change and not because of a change in their conviction, it creates a cascade of selling pressure. The price drops. As the price drops, it triggers stop-loss orders, which creates further selling. It is a self-fulfilling feedback loop manufactured by the rule change. This is what is technically referred to as a washout or a shakeout. It is designed to transfer positions from weak hands, leveraged retail traders, to strong hands, institutions with deep pockets. For those of us who have weathered previous market cycles, this tactic is familiar. It brings to mind the old adage, history may not repeat itself exactly, but it certainly rhymes. To understand the probable outcome of today's volatility, we must look back to the last great silver bull market of 2011. The parallels are striking, and they offer a roadmap for what lies ahead. In early 2011, silver was in the midst of a historic parabolic move. Driven by fears of quantitative easing and dollar debasement following the 2008 crisis, silver surged from $18 to nearly $50. The sentiment was euphoric, and retail participation was at an all-time high. The response from the exchanges was aggressive. In late April and early May of 2011, the CME raised margin requirements not once, but 5 times in a span of 9 days. They did not merely adjust the margins, they weaponized them. The most infamous of these events occurred on Sunday evening, April 24, 2011, a date remembered in the precious metals community as Silver Sunday. The exchange enacted a massive margin hike during a time of low liquidity, when global markets were largely closed. The result was a collapse in the paper price. Silver fell from approaching $50 down to $26 over the ensuing months. The narrative in the mainstream financial press was that the bubble had burst. They claimed that the fundamentals of silver were flawed and that the mania was over. However, a careful analysis reveals a different truth. The price did not collapse because the industrial demand for silver disappeared. Solar panels were still being built. Electronics were still being manufactured. The price collapsed because the leverage was removed from the system. But here is the crucial data point that most analysts miss. The suppression of 2011 delayed the bull market, but it did not kill the long-term thesis. Following the crash, silver spent years consolidating, but the underlying monetary issues, the expansion of debt and the printing of currency, continued unabated. Now, in 2026, we are seeing the same playbook. The price breaks a key psychological level, 85s, the physical market tightens, Shanghai at 93, and the authorities step in to change the rules. Why now? Why change the margin calculation method precisely when the banks are most vulnerable to a short squeeze? The answer lies in the nature of risk management. The clearinghouses and exchanges are ultimately responsible for the solvency of the market. If the price of silver were to gap up to $100 or $120 too quickly, the entities holding short positions, major bullion banks, would face catastrophic losses that could exceed their ability to pay. If a major bank fails to meet its obligation, the exchange itself is on the hook. Therefore, raising margins is a defensive measure. It is an attempt to cool the reactor core before it melts down. It is a tacit admission that the system is under extreme stress. They are sacrificing the retail investor to save the institutional structure. While the CME's margin adjustments provide the immediate catalyst for today's price action, we must zoom out to understand the broader economic weather patterns. We cannot view silver in a vacuum. It is a monetary asset, and its behavior is inextricably linked to the health of the global economy and the currency regime. In this regard, we turn our attention to a compelling piece of analysis recently presented by macro strategist Tom Bradshaw. Mr. Bradshaw has identified a specific recurring pattern that has served as a harbinger for economic recessions over the last half-century. He calls it the 38% signal. The premise is straightforward but statistically profound. Whenever the price of gold rises by more than 38% within a single calendar year, a severe economic recession follows within 12 months. Let us examine the historical data points that validate this signal. First, consider the 1973 or 1974 recession. In 1973, amidst the oil shock and the breakdown of the Bretton Woods system, gold rose over 40%, moving from approximately $63 to $97 per ounce. The following year, 1974, the United States entered a stagflationary recession that devastated the stock market and eroded the standard of living for millions of Americans. Then, we must look at the 1980 recession. In the final blow-off top of the 1970s bull market, gold rose over 100% in 1979 or 1980, peaking at $850. Immediately following this signal, the U.S. economy entered the double-dip recession of the early 1980s, forcing Federal Reserve Chairman Paul Volcker to raise interest rates to 20% to save the dollar. Finally, recall the 2008 global financial crisis. In the lead-up to the housing collapse, gold signaled the danger early. In 2007, 2008, gold rose over 30%. We now fast forward to the year just concluded, 2025. Gold began the year near $3,000 and finished over $4,600, a rise significantly exceeding the 38% threshold. If history is our guide, the signal has been triggered. The alarm is ringing. The market, in its collective wisdom, has sniffed out the rot in the financial system and has fled to safety ahead of the collapse. We are currently standing on the precipice of a major economic contraction. I'm interested in your Main Street perspective. While the official government statistics often paint a rosy picture, what are you seeing in your local economy? Are you noticing the slowdown that Bradshaw's 38% signal predicts? Please drop a note in the comments. Your real-world observations are often more valuable than any government report. This brings us to a critical nuance that inexperienced investors often overlook. How does silver behave at the onset of a recession? Contrary to popular belief, precious metals often sell off during the very first phase of a crisis. This is known as a liquidity crunch. When the credit markets freeze, when banks stop lending and margin calls go out across the stock market, investors are desperate for cash. They do not sell what they want to sell. They sell what they can sell. Gold and silver are highly liquid assets. In 2008, during the initial panic, gold dropped from $1,000 to $730 and silver plummeted from $21 to $8. A superficial observer might have looked at that price action and concluded, silver is not a safe haven. It is crashing with everything else. That conclusion would have been a devastating error. Why? Because that dip was the final opportunity to acquire assets before the Federal Reserve stepped in. Once the central bank responded to the crisis by printing trillions of dollars, quantitative easing, the metals decoupled from the deflationary crash and began an inflationary moonshot. From the 2008 lows, silver rose nearly 500% over the next 3 years. This is the scenario we face today. The CME's margin hike is likely the first domino in a broader liquidity event. We may see lower prices in the short term as the paper positions are washed out. But this volatility is merely the prelude to the main event, the monetary response. As we navigate this period of manufactured volatility, it is imperative to distinguish between price and value and between the paper market and the physical market. The price you see on your computer screen, the spot price, is derived largely from the trading of futures contracts on the COMEX. These are paper promises. They are claims on silver that, in the vast majority of cases, are settled in cash, not metal. It is a market of leverage and speculation. The physical market, however, is the market of reality. It is the market where ounces are exchanged for currency. It is the market where industrial users, technology companies, defense contractors, solar manufacturers, compete for raw materials. Currently, we are witnessing a historic divergence between these two markets. While the COMEX paper market is being battered by margin hikes, the Shanghai Futures Exchange, SFE, tells a different story. In Shanghai, silver is trading at approximately $93 per ounce. This represents an $8 premium over the Western spot price. Why the discrepancy? Because the Shanghai market is physically settled. If you buy a contract in Shanghai, you are far more likely to take delivery of the metal. Therefore, the Shanghai price reflects the actual supply and demand for the physical commodity, whereas the COMEX price reflects the sentiment of speculators and the maneuvering of banks. Closer to home, we see similar evidence. If you attempt to purchase physical silver eagles or bars from a reputable U.S. dealer today, you will not pay the spot price of $85. You will pay a premium of $8, $10, or even $15 per ounce. Furthermore, you will likely face shipping delays of 8 to 10 weeks. This is the market screaming the truth. There is a shortage. The paper market can be manipulated, margins can be raised, rules can be changed. But the CME cannot print silver ounces. They cannot change the laws of physics. Have you visited a coin shop or tried to order bullion online recently? I'd love to hear your boots-on-the-ground reports. Are you seeing these delays and premiums in your area? Let's help each other track the real supply situation. Leave a comment with what you're seeing. Consider the industrial landscape. The modern economy is addicted to silver. It is the most conductive metal on Earth. It is essential for photovoltaic cells, electric vehicles, and defense technology. The global push for green energy ensures rising demand for solar panels, which consume massive amounts of silver. An EV uses significantly more silver than an internal combustion engine vehicle. Advanced guidance systems and electronics require silver. Can a margin hike at the CME convince a solar panel factory that they no longer need silver? Can a rule change in Chicago convince the Chinese military to stop building missiles? Of course not. Industrial demand is inelastic to paper market games. Manufacturers must buy the metal to stay in business. Furthermore, we must consider the supply side. China, a major producer, has implemented strict export licensing systems. They are hoarding their domestic production. They understand the strategic value of the metal. The West is engaging in financial engineering, changing margin rules, while the East is engaging in resource accumulation. Given this backdrop, a manipulated paper market, a starving physical market, and a looming recession that will necessitate historic money printing, where is the price heading? Analyst Tom Bradshaw has projected a price target of $375 per ounce for silver by the year 2028. To the conservative mind, this number may seem hyperbolic. A 400% increase from current levels sounds like the stuff of fantasy. However, when we view silver not just as a commodity, but as a monetary metal adjusting to a new quantity of fiat currency, the math becomes plausible. In 1980, gold hit $850. Adjusted for real inflation using 1980 methodology, that peak would be significantly higher today. Silver hit $50 in 1980 and again in 2011. Since 2011, the global money supply has not just doubled, it has exploded. The U.S. national debt has moved from 14 trillion to numbers that defy comprehension. If we are indeed entering a recession triggered by the 38% signal, the government response will be uniform. They will print. They will print to save the bond market. They will print to fund unfunded liabilities. They will print to stimulate the economy. When trillions of new currency units enter the system, they chase a finite amount of real assets. Silver is a tiny market. It is like a bathtub compared to the ocean of the bond market. When even a small fraction of global capital flees from failing currencies and bonds into the safe haven of precious metals, the price does not just rise, it goes vertical. 375 is not a prediction of silver becoming expensive. It is a prediction of the dollar becoming cheap. It is a repricing of a hard asset in terms of a failing paper currency. The banks know this. This is the great irony of the situation. The institutions that are currently shorting the paper market and raising margins to flush you out are the same institutions that are quietly accumulating physical bars in their vaults. They are shaking the tree to make the apples fall, so they can gather them for themselves. However, to assume this is merely a game of domestic banking profits is to miss the forest for the trees. There is a deeper, more ominous layer to this struggle that we must confront, one that explains why the stakes are existential, not just for your portfolio, but for personal liberty itself. Part 6. The geopolitical accelerant, the battle for currency supremacy. We must recognize that the suppression of silver prices via margin hikes on the COMEX is not happening in a geopolitical vacuum. It is occurring against the backdrop of the most significant realignment of the global monetary order since the Bretton Woods Agreement of 1944. The rug pull we are witnessing in Chicago is inextricably linked to the frantic attempts by Western central planners to maintain the illusion of dollar hegemony in a world that is rapidly rejecting it. For decades, the United States enjoyed the exorbitant privilege of printing the world's reserve currency. This allowed us to export our inflation to other nations and run massive deficits without immediate consequence. But that era is ending. The weaponization of the US dollar through sanctions, seizing the reserves of sovereign nations and freezing them out of the SWIFT system, has sent a chilling message to the rest of the world. If you do not obey, your money is not safe. The response from the East, specifically the BRICS nations, Brazil, Russia, India, China, South Africa, and their expanding coalition, has been to accelerate the move toward hard assets and away from paper promises. This is why we are seeing central banks buying gold at a pace not seen since 1967. They are not buying futures contracts. They are buying physical bars and repatriating them to their own vaults. They are draining the London and New York exchanges of physical inventory to back their own currencies and trade settlements. Now, connect this back to silver. Silver is the poor man's gold. As central banks corner the gold market and drive the price beyond the reach of the average citizen, the populace turns to silver as their primary vehicle for wealth preservation. The banking elite understand this dynamic perfectly. They know that a breakout in silver to $100, $200, or $375 is not just a financial event. It is a vote of no confidence in the fiat currency system. If silver goes to $375, it signals to the world that the dollar has failed as a store of value. It exposes the rampant inflation that the government statistics try to hide. Therefore, suppressing the price of silver is a matter of national security for the establishment. They must keep the price contained to maintain the facade of stability. The margin hikes are a tool of desperation to prevent the canary in the coal mine from singing too loudly. Furthermore, we must look at the impending arrival of central bank digital currencies, CBDCs. The Federal Reserve and other major central banks are racing to implement programmable digital money. This is the ultimate control grid, money that can be tracked, traced, and even turned off if you do not comply with certain mandates. In a world of digital surveillance, physical silver represents one of the last bastions of financial privacy and freedom. It is anonymous, it is untraceable, and it cannot be deleted with a keystroke. This is a topic that concerns many of us who value privacy. Where do you stand on the issue of CBDCs? Do you view holding physical silver as an act of financial protest against digital surveillance? I think this is one of the most important debates of our time, and I'd value your perspective in the comments. The rush we are seeing into physical silver is partially driven by individuals who see the writing on the wall. They're exchanging surveillance tokens, digital dollars, for freedom money, silver. The establishment fears this exit. They want you trapped in the digital system where negative interest rates and expiration dates on money can be applied. A soaring silver price incentivizes more people to exit the system, which is exactly what they are trying to prevent with these margin shenanigans. So, when you see the CME raise margins, understand that you are witnessing a skirmish in a much larger currency war. They are trying to make it painful for you to hold real money. They are trying to force you back into the dollar system just as the rest of the world is abandoning it. They are trying to shake you out of your position before the inevitable devaluation of the currency creates a tidal wave of demand for hard assets. The rug pull is their attempt to buy time, to keep the illusion alive for one more day, one more week, one more month. But against the combined weight of the BRICS nations, industrial demand, and a waking populace, their paper walls are destined to crumble. Part 7. Strategic implications for the prudent investor. So, where does this leave us? How should a prudent individual, perhaps looking to preserve wealth for retirement or legacy, navigate these turbulent waters? First, we must reject the emotional response that the authorities are trying to elicit. When you see a red candle on a chart or hear news of a margin hike, do not react with fear. React with understanding. Recognize this as a tactical move in a financial war. Do not let the volatility shake your conviction in the fundamentals. If there is one lesson to be learned from the CME's actions, it is the danger of playing the game in their casino. If you are holding leveraged futures contracts, you are renting your position. You are subject to their rule changes. They can raise margins to 100%. They can change the contract specs. They can force cash settlements. For the average investor, the paper market is a trap. It is designed to separate you from your capital through volatility. The antidote to paper manipulation is physical ownership. If you own physical silver, coins, bars, or rounds stored in your own possession or a fully allocated, segregated vault, the CME's margin rules are irrelevant to you. A margin call cannot be issued on a silver eagle sitting in your safe. A rule change cannot force you to sell a 100-ounce bar that you own outright. By holding the physical asset, you remove the counterparty risk, you remove the leverage, you remove the ability of the financial system to shake you out. Finally, regard the manufactured sell-off as a buying opportunity. If it succeeds in driving the paper price down to $80 or $78 in the coming days, view it for what it is, a gift. It is a sale on real money. Do not try to time the absolute bottom. Do not wait for the mainstream media to give you the all-clear signal. By the time CNBC or the Wall Street Journal tells you it is time to buy silver, the price will likely be $150, and physical inventory will be unobtainable. Pay the premium if you must. The difference between paying $90 or $95 today will seem trivial when the price is trading at $300. The risk is not overpaying by a few dollars. The risk is being left holding paper currency when the music stops. Friends, we are living through a period of transition that occurs perhaps once every 80 years. The debt supercycle is concluding. The trust in fiat currencies is eroding. The geopolitical order is fracturing. The events of January 13th, 2026, the CME margin nuking, will likely be looked back upon by economic historians as a pivotal moment. It was the moment the establishment admitted, through their desperate actions, that they had lost control of the price. They are trying to buy time. They are trying to scare the weak hands into submission. They want you to believe that the rally is over, that the rules have changed, and that you should retreat to the safety of dollars and bonds. But we know better. We have seen the 38% signal. We see the Shanghai premium. We understand the industrial necessity of the metal. The paper market is the Titanic, struggling to stay afloat amidst a sea of liquidity and leverage. Physical silver is the lifeboat. It is limited, it is essential, and it is the only asset that has no counterparty liability. Do not let them steal your position. Do not let them shake you out. The volatility is the price we pay for the transfer of wealth that is to come. Stay calm, stay diversified, and above all, stay in the real world of physical assets. Thank you for your time and your trust. Let us watch the markets closely in the days ahead, not with fear, but with the quiet confidence of those who know how the story ends.